What if I told you that the safe way you've been investing could be costing you thousands of dollars? A shocking 65% of the time, investors who slowly drip their money into the market actually earn less than those who invest all at once. In this video, I'm going to show you why conventional wisdom about dollar cost averaging might be holding your wealth back. We'll follow Teresa and Connor through a 10-year investment journey with the same $10,000, but their dramatically different approaches lead to a surprising gap in their final results. Stick around to discover which strategy science says you should actually be using. Meet Teresa and Connor, two investors, one $10,000 decision. Imagine this. You and your friend both just received an unexpected $10,000 windfall. Maybe it's a year-end bonus, an inheritance from a generous relative, or even a lucky lottery win. Now comes the exciting but slightly nerve-wracking question. What's the smartest way to invest this money? This exact scenario happened to our two friends, Teresa and Connor. They're both in their early 30s, work in similar corporate jobs, and have been building their investment portfolios for a few years. But when each received a surprise $10,000 bonus, they took completely different approaches to investing it. Teresa is what you might call a confident investor. She's done her research and believes strongly in one core principle. The sooner your money is in the market, the better. When her $10,000 hit her bank account, she didn't hesitate. Within 3 days, she had transferred the entire amount into her brokerage account and invested it all in a diversified portfolio of low-cost index funds tracking the total stock market. I know the market might go down tomorrow, Teresa told Connor over coffee, but it might also go up. And historically, it's spent a lot more time going up than down. So why keep my money on the sidelines? Connor, on the other hand, physically cringed at Teresa's approach. He's more cautious by nature and worries constantly about market timing. What if you just invested at the absolute peak? He countered. You could lose thousands in a market correction. Connor took a different path with his $10,000. He set up an automatic investment plan to spread his money out over 12 months, about $833 invested on the 15th of each month. In his mind, this approach protected him from the terrible scenario of investing everything right before a market crash. This way, if the market drops next month, I'll actually be buying at lower prices with most of my money, Connor explained. It's all about reducing risk. The fascinating thing about Teresa and Connor is that they both genuinely believe their approach is smarter. They've both read financial advice articles that support their position. They both sleep well at night thinking they've made the right choice. But here's the thing, they can't both be right. At least not completely. One of them is statistically making a costly mistake that could potentially cost thousands in missed returns over time. But which one? If we could peer into Teresa's mind right after she hit the confirm button on her lump sum investment, we'd see a mix of confidence and anxiety. She knows the historical data supports her decision, but there's still that nagging worry. What if this is terrible timing? She checks the market more frequently in those first few weeks, wincing slightly during down days, but reminding herself to focus on the long term. Meanwhile, Connor experiences almost immediate relief after setting up his automatic investment plan. He feels protected against market volatility and enjoys the psychological comfort of knowing most of his money is still safe in his savings account. Each monthly investment feels like a small, manageable decision rather than one big, scary plunge. Their emotional experiences couldn't be more different. Teresa faces her investment anxiety all at once, like ripping off a fly bandage. Connor spreads his anxiety out in smaller doses over the year. But emotions aside, which approach actually leads to better financial outcomes? To answer this question definitively, we're going to follow Teresa and Connor's investment journey over 10 years using real market data. We'll track how their identical $10,000 windfalls grow or shrink through market ups and downs, bull markets and corrections, and even through major economic events. By the end, we'll see exactly how much money each of them has, down to the dollar. What makes this comparison so fascinating is that one of these approaches has a clear statistical advantage that most investors completely ignore. And it's not just a small edge, we're talking about a significant difference that compounds dramatically over time. Even more interesting is why so many investors, maybe even you, consistently choose the less optimal strategy. The answer has less to do with math and more to do with human psychology, specifically how our brains are wired to avoid pain and seek comfort, often at the expense of our long-term financial health. Think about your own approach for a moment. If someone handed you $10,000 to invest today, would you be more like Teresa or Connor? Would you put it all in at once, or would you spread it out over time? And what's driving that decision? Statistical analysis or emotional comfort? Is playing it safe with your money actually costing you thousands? That's the question we're going to answer definitively in this video. We'll look at historical data spanning over 150 years of market returns, examine the psychological factors that drive our investment decisions, and ultimately provide you with a framework to make smarter choices with your next financial windfall. Before we see how Teresa and Connor's investments perform over those 10 years, let's clarify exactly what these two strategies are, why they exist, and the fundamental differences between them that make such a dramatic impact on your investment returns. Defining the battle, lump sum versus dollar cost averaging. When it comes to investing a windfall, your instinct to protect yourself from market crashes might be sabotaging your financial future. While spreading your investments over time feels emotionally safer, this widely recommended approach comes with a hidden cost that most financial experts don't emphasize enough. Let's unpack why the supposedly safer option might actually be the riskier choice for your long-term wealth. So what exactly are these two investment strategies that Teresa and Connor are putting to the test? Let's break them down in clear terms. Lump sum investing is exactly what it sounds like. Taking your available money and putting it all to work in the market immediately. No waiting, no hesitation. The money moves from cash to your chosen investments in one swift motion. It's the investment equivalent of diving into the deep end of the pool rather than wading in slowly. Dollar cost averaging, DCA, on the other hand, is the gradual approach. Instead of investing all at once, you divide your total amount into equal portions and invest them at regular intervals, whether that's weekly, monthly, or quarterly. It's methodical, structured, and feels much more controlled. What's fascinating is how frequently DCA gets recommended as the safer option by financial professionals. Visit almost any popular finance website or speak with many advisors, and they'll often suggest this gradual approach, especially when you're dealing with a significant amount of money. The conventional wisdom has become so entrenched that most investors don't even question it. But why is this strategy so widely recommended? The answer lies in behavioral psychology rather than pure financial mathematics. Financial advisors understand that one of their primary jobs isn't just to maximize returns, it's to prevent clients from making panic-driven decisions during market volatility. When you invest gradually through dollar cost averaging, you're essentially hedging against the risk of terrible timing. The fear is investing everything the day before a market crash, an anxiety-inducing scenario that keeps many investors up at night. DCA offers psychological comfort by ensuring you'll never invest your entire sum at the absolute worst moment. Picture how these strategies deploy capital over time. With lump sum investing, your money chart shows an immediate vertical jump. One day you have cash, the next day it's fully invested in the market. With DCA, the chart shows a steady stair-step pattern as portions of your money gradually shift from cash to investments over months or even years. It's important to clarify something that often gets confused. Regular contributions from your paycheck into retirement accounts like 401ks or IRAs are technically a form of dollar cost averaging, but that's not what we're discussing here. Making consistent contributions from your income is absolutely a smart strategy. What we're specifically examining is how to handle windfalls, those larger, one-time sums of money, like inheritances, bonuses, or other financial windfalls. The standard argument for DCA is compelling on its face. By spreading out your investments, you reduce the risk of putting all your money into the market right before a significant drop. If the market declines after your first installment, You'll have the opportunity to buy additional shares at lower prices with your subsequent investments. This averaging effect feels like protection against bad luck and poor timing. This psychological comfort is powerful. Nobody wants to feel the regret of investing everything right before watching the market plummet. DCA promises to minimize that specific type of pain, and that's why it remains so popular despite what the math actually tells us about long-term performance. What many financial advisors don't emphasize enough is the opportunity cost that comes with keeping portions of your money on the sidelines. Every day that some of your money isn't invested is a day it isn't working for you. It isn't capturing dividends, interest, or potential market growth. This is the hidden cost of emotional comfort. Beyond the emotional aspects, there's a fundamental misconception about what dollar-cost averaging actually achieves. Many investors believe that DCA guarantees better returns by averaging out the cost of shares over time. The assumption is that by buying at different price points, you'll somehow outsmart the market's ups and downs. But this misunderstands how markets typically behave over longer periods. The truth is that DCA isn't really about maximizing returns. It's a behavioral strategy designed to prevent worst-case scenarios and ease investment anxiety. It's about managing emotions more than optimizing mathematics. And while there's certainly value in approaches that help us stick with our investment plans, we should be clear-eyed about the potential trade-offs involved. What's particularly interesting is how the financial industry has collectively decided that the emotional benefits of DCA outweigh the statistical disadvantages for most investors. This speaks volumes about how investment professionals view retail investors' psychological tendencies. They essentially believe most people need training wheels, even if those training wheels might slow them down. The fundamental difference between these strategies isn't just about timing. It's about maximizing your money's time in the market versus trying to time your entry into the market. And this distinction is crucial for understanding why the math tends to favor one approach over the other in most historical scenarios. Think about it this way. Markets have a natural upward bias over long periods. Despite crashes, corrections, and bear markets, the overall trajectory has been positive when measured across decades. This means that statistically speaking, money invested sooner has a higher probability of capturing more growth than money waiting on the sidelines. Every day that a portion of your windfall sits in cash while you dollar-cost average is a day that money isn't participating in the market's natural tendency to rise over time. The trade-off you're making with DCA is essentially exchanging potential returns for emotional comfort, paying a premium for peace of mind, if you will. What's most surprising is that this trade-off isn't small. The cost of choosing psychological comfort over mathematical optimization can add up to thousands of dollars in lost potential returns over time. And here's where things get really interesting. This gap widens dramatically the longer your investment horizon stretches. For younger investors with decades ahead of them, the cumulative impact of choosing DCA over lump sum investing for their windfalls could potentially translate into tens or even hundreds of thousands of dollars in opportunity cost by retirement age. That's a steep price to pay for emotional comfort, especially when there might be other ways to manage investment anxiety without sacrificing so much potential growth. The question then becomes, are you willing to potentially leave money on the table in exchange for reduced short-term anxiety? Or would you rather embrace the statistically advantageous approach, even if it comes with more emotional volatility in the short term? The shocking stats, what 150 years of market data reveals. The cold, hard mathematical truth hiding in 150 years of market performance reveals something that most investors are unknowingly choosing to ignore. When we look at the actual data instead of relying on our gut feelings, the results are genuinely surprising. Let's talk numbers. Major financial institutions like Vanguard and Northwestern Mutual have conducted extensive research analyzing decades of market performance. These aren't small sample sizes or cherry-picked time periods. We're talking about comprehensive studies that examined market behavior across multiple eras, economic cycles, and even major financial crises. What these studies found completely contradicts what most casual investors believe. According to this research, lump sum investing, putting all your money in the market at once, outperforms dollar cost averaging approximately 65 to 75% of the time. That's not a small edge. That's a significant statistical advantage that most people are actively choosing to ignore. Think about what that really means. If you were playing a game where you could choose between two strategies and one gave you a 65 to 75% chance of winning, while the other only won 25 to 35% of the time, which would you choose? In the investing world, most people are actually picking the strategy with the lower probability of success. The performance gap is even more striking when you look at the actual returns. The data shows that lump sum investing produced returns that were 1.5% to 2.4% higher on average than dollar cost averaging. Those percentage points might not sound huge, but over time, they compound into significantly larger account balances. Let's break down what this looks like across different market periods. During the prosperity of the 1950s, lump sum investors captured the post-war economic boom from day one, while DCA investors gradually eased in, missing crucial early growth. Fast forward to the volatile 1980s, and we see the same pattern. Despite the market swings, lump sum investors ended up with larger portfolios by the decade's end. Even in the tumultuous 2000s, which included both the dot-com crash and the 2008 financial crisis, lump sum investing still came out ahead in the majority of starting months. It's not that DCA never wins, it's just that it wins far less frequently than most people assume. So, why does lump sum investing perform better? The answer comes down to a fundamental truth about financial markets. They tend to go up over time. Historical market data shows that lump sum investing tends to outperform specifically because it allows investors to capture growth potential immediately rather than waiting. Every day your money sits on the sidelines is a day it's not working for you in the market. This is precisely why time in the market is so crucial for maximizing investment growth. The data from the S&P 500 illustrates this perfectly. Missing just a few of the best performing days can dramatically reduce your overall returns. When you dollar cost average, you're guaranteeing that a portion of your money will miss some of the market's upward movement. The performance gap between these two strategies becomes particularly pronounced during bull markets. When markets are trending upward, lump sum investments capitalize on these upward trends immediately and fully. Your entire investment rides the wave from day one. I know what some of you are thinking, but what about bear markets? Surely DCA wins then. And you'd be partially right. During bear markets, dollar cost averaging can help mitigate some losses by allowing you to purchase shares at lower prices as the market declines. However, and this is crucial, research shows that even this advantage typically disappears once markets recover. The lump sum approach generally pulls ahead again. What's most interesting about these findings is that the fundamental difference between these two strategies isn't just about timing the market. It's about maximizing the time your investments spend in the market. This distinction is critical for understanding why one strategy consistently outperforms the other. The comprehensive analysis of these strategies shows that lump sum investing typically results in better outcomes primarily due to the time value of money. By investing everything at once, your full principal amount begins compounding immediately, allowing your investments to grow over a longer period. Let's put this in perspective with a concrete example. Imagine we have two investors, each with $10,000 to invest. The first invests the full amount on January 1st, while the second invests $833 monthly over the course of a year. If the market returns 10% that year, the lump sum investor would have $11,000 by year end. The dollar cost averager, however, would have less because portions of their money weren't invested during the full growth period. Now the million-dollar question. How much of a difference would this make for Teresa and Connor over their 10-year investment journey? Would it be a few $100s, a few thousand, or perhaps tens of thousands? Before I reveal that, I want you to take a moment and guess. Based on what we've discussed about the performance gap between these strategies, how much more do you think Teresa's lump sum approach might earn compared to Connor's dollar cost averaging over a decade? The answer might shock you. The compounding effect of that initial 1.5 to 2.4% performance gap can grow exponentially over a 10-year period. What starts as a small percentage difference can balloon into a substantial dollar amount, potentially enough to fund a vacation, make a down payment on a car, or significantly boost retirement savings. And this performance gap becomes even more dramatic when we factor in longer time horizons. For someone in their 20s or 30s with decades until retirement, choosing the statistically inferior strategy could potentially mean missing out on tens or even hundreds of thousands of dollars by retirement age. When we look at this data objectively, one thing becomes abundantly clear. Keeping money on the sidelines doesn't actually reduce your risk, it increases the risk of missing out on potential returns. The mathematical evidence suggests that the perceived safety of dollar psychology trap, why we choose lower returns. Despite the compelling math in favor of lump sum investing, there's a powerful force causing most of us to choose the statistically inferior strategy. The surprising answer isn't found in financial formulas, but in the wiring of our prehistoric brains, where the fear of loss hits us twice as hard as the joy of gains. Welcome to the fascinating world of behavioral finance, where our emotions and psychological biases frequently override logic when it comes to money decisions. This isn't just about irrational people making poor choices. It's about how our brains are fundamentally designed to protect us from threats, a design that worked great for survival on the savannah, but creates serious problems in the modern financial marketplace. Let's start with loss aversion, perhaps the most powerful psychological force in investing. Studies show we feel the pain of losses about twice as intensely as we enjoy equivalent gains. Imagine investing $10,000 as a lump sum on Monday, only to watch the market drop 10% by Friday. That $1,000 loss feels crushing, like someone punched you in the gut. Now imagine gaining $1,000 instead. Nice, but not nearly as emotionally impactful as the loss, right? This asymmetric emotional response explains why so many investors choose dollar cost averaging despite knowing it's mathematically inferior. It's not about maximizing returns, it's about minimizing emotional pain. The fear of regret is so powerful that investors willingly accept lower expected returns just to avoid that potential stomach-churning feeling of investing right before a market drop. Think about it. If you invest a lump sum right before a crash, you'll forever remember and regret that decision. But if you dollar cost average into a rising market and miss out on gains, that pain is much less acute and easier to rationalize away. We're essentially paying a premium in the form of lower expected returns for emotional insurance. Another fascinating psychological trap we fall into is overestimating our market timing abilities. Despite overwhelming evidence that even professional investors struggle to consistently time market movements, we believe we're somehow different. We convince ourselves that we can spot patterns, feel market sentiment, or predict upcoming drops. This overconfidence leads to a dangerous cycle. We delay investing while waiting for the perfect entry point, missing growth opportunities along the way. When the market eventually drops, as it always does at some point, we congratulate ourselves on our foresight, even if we missed years of gains while waiting. This selective memory reinforces our belief in timing abilities that simply don't exist. Confirmation bias makes this problem even worse. We naturally seek out and remember information that supports our existing beliefs while filtering out contradictory evidence. If you're nervous about investing a lump sum, you'll notice every news headline about potential market troubles while glossing over positive economic indicators. Your social media feed and news consumption will gradually skew toward confirming your fears rather than challenging them. Remember how you can vividly recall that friend who invested everything right before a crash, but you've forgotten about the 3 other friends who did the same thing and saw their investments grow substantially? That's confirmation bias at work, creating a distorted view of investment reality. Even more fascinating is how we fall into the trap of procrastination around investment decisions. The anxiety about making the wrong choice can be so paralyzing that we make no choice at all. Money sits in checking accounts earning nothing while we debate the perfect entry strategy. This delay can result in significant losses over time, as even a few years of postponed investing can make a substantial difference in long-term wealth. Here's where it gets really interesting. Our brains aren't just making us cautious. They're actively working against our financial interests in service of emotional comfort. Every time we choose dollar-cost averaging over lump-sum investing, we're essentially saying, I'll gladly accept lower expected returns in exchange for less anxiety. It's like paying an invisible tax on our investments, with the proceeds going to our emotional well-being rather than our financial future. The psychological impact of investing a lump sum right before a market drop can be devastating. Picture checking your investment account and seeing your hard-earned money suddenly worth thousands less than when you invested it. For many people, this scenario triggers such intense anxiety that they'll pay a significant price in potential returns just to avoid the possibility. What's truly fascinating is that these psychological forces affect experienced investors and beginners alike. Even financial professionals who understand the mathematics perfectly well often choose dollar-cost averaging for their personal finances. The emotional pull is simply that powerful. Experts in behavioral finance suggest that the biggest investment risk is not market volatility, but rather the emotional reactions investors have to it. When markets drop sharply, our instinctive fight-or-flight response kicks in. The ancient parts of our brain don't distinguish between a charging predator and a plunging stock chart. Both register as threats requiring immediate action. This explains why perfectly rational people make irrational decisions like panic selling at market bottoms or freezing up when investment opportunities arise. This psychological vulnerability explains why so many investors lock in losses during market downturns. The emotional pain becomes so intense that selling feels like sweet relief, even though it guarantees the loss becomes permanent rather than temporary. By contrast, those who can manage their emotional reactions often emerge from market crashes with substantially better results. The story of market timing failures is particularly compelling. Studies of investor behavior consistently show that the average investor underperforms the very funds they invest in because of poorly timed entries and exits. A fund might return 8% annually, but the average investor in that same fund might only realize 5 to 6% because they buy high when things feel safe and sell low when panic sets in. What makes this even more interesting is that we're rarely aware of these psychological forces as they're happening. Most investors who choose dollar-cost averaging don't consciously think, I'm selecting a mathematically inferior strategy because I'm loss-averse. Instead, it feels like the prudent, reasonable choice. Our brain presents it as the smart option while hiding the emotional motivations driving the decision. For Teresa and Connor, these psychological factors profoundly shaped their investment journeys. Teresa likely experienced intense anxiety after her lump sum investment, especially during any market dips in the early months. Connor, meanwhile, probably felt a sense of validation and relief during market downturns, as his strategy allowed him to buy at lower prices. The emotional paths they traveled were entirely different, even if they were investing in identical assets. The 10-year showdown, Teresa versus Connor's investment results. The emotional comfort Connor gained from dollar-cost averaging came with a price tag. But exactly how much did that peace of mind actually cost him? When we compare Teresa and Connor's accounts after a decade of real market performance, the numbers tell a story that few financial advisors are willing to share with their nervous clients. Let's fast forward 10 years and see what happened to our two investors. Remember, they started with the exact same $10,000 windfall, but Teresa put everything into the market immediately, while Connor spread his investment over 12 monthly installments of $833. If we track their investments through a typical decade with an 8% average annual return, the difference becomes immediately apparent. By the end of year one, Teresa's account already showed a meaningful advantage. Her entire $10,000 grew to approximately $10,800, capturing that full first-year return. Connor, meanwhile, had a portion of his money sitting in cash for most of that crucial first year. Since his last installment only went in during the final month, much of his money missed out on the market's growth. This early gap continued to widen through the power of compounding. Each dollar Teresa had working from day one wasn't just earning returns, it was earning returns on those returns. By year 3, what looked like a small initial advantage had already grown into hundreds of dollars of difference. The visualization is striking when you chart their balances side by side. Teresa's line starts higher and the gap widens with each passing year, like two runners where one got a head start and gradually increases their lead. The mathematical principle at work is simple but powerful. Money invested earlier has more time to grow. What's most fascinating is that Connor's strategy, despite its psychological benefits, created a permanent disadvantage that he could never overcome under normal market conditions. Even after his final installment was invested, his portfolio was perpetually playing catch-up. The money that sat in cash during those early months represented a missed opportunity that compound growth would continue to magnify over the decade. By year 5, the midpoint of our analysis, the performance gap had widened substantially. If the market had indeed delivered that 8% average annual return, Teresa's $10,000 had grown to about $14,693, while Connor's balance lagged behind at approximately $14,100. That difference of nearly $600 might not seem life-changing, but remember, this gap appeared despite both investors contributing exactly the same amount. The truly eye-opening moment comes when we reach the 10-year mark. After a decade of identical market conditions, Teresa's portfolio had grown to approximately $21,600, while Connor's investment reached only about $20,400. That's a difference of $1,200 over 12% of their original investment amount, simply from Teresa's decision to invest immediately rather than gradually. Think about what this means in practical terms. Connor essentially paid $1,200 for the psychological comfort of dollar-cost averaging. That's not a small price for peace of mind, especially considering it represents 12% of his original capital. What's even more concerning is how this disparity would continue growing if they left their investments untouched for retirement. If we extend our timeline from 10 years to 30 years, a typical investment horizon for retirement savings, the gap between Teresa and Connor's accounts would balloon to many thousands of dollars, potentially altering the quality of their retirement lifestyles. But the numbers only tell half the story. Let's also consider their emotional journeys over this decade, because investment success isn't just about mathematical outcomes, it's about actually sticking with your strategy through all market conditions. Teresa certainly experienced more volatility in her emotions, especially early on. In the first few months after her lump sum investment, every market dip felt personal and amplified. When the market dropped 5% just 2 months after her investment, she saw $500 of her hard-earned money seemingly vanish. Those early days tested her resolve, and she likely checked her account balance far more frequently than was healthy. Connor's emotional journey was markedly different. During that same 5% market drop, he actually felt a sense of validation. His strategy was working exactly as designed. He was now buying shares at a discount. Each monthly investment brought a small sense of accomplishment rather than anxiety. He was able to sleep at night, knowing that market volatility was working in his favor, at least psychologically. The irony is that Connor's strategy, while emotionally comfortable, created a mathematical handicap that grew larger with time. His psychological comfort came with a quantifiable cost that accumulated silently in the background. The very approach that financial advisors recommended to help him avoid regret actually guaranteed a form of opportunity cost regret. The regret of knowing he could have had significantly more money by following Teresa's approach. This raises an important question for viewers. Which would you prefer? The temporary discomfort of Teresa's approach, followed by superior results, or Connor's smoother emotional journey with permanently lower returns? When framed this way, many investors might reconsider their instinctive preference for dollar-cost averaging. It's worth noting that the performance gap between these strategies isn't theoretical. It's backed by extensive historical data. When researchers analyzed thousands of different 10-year investment periods, they consistently found that lump sum investing produced superior results in the vast majority of cases. In fact, one comprehensive study found that lump sum investing outperformed dollar cost averaging in approximately 78% of 9-year periods. The visualization of Teresa and Connor's growing account disparity helps illustrate why financial educators often say that time in the market beats timing the market. Every day that a portion of Connor's money sat in cash, waiting for its scheduled investment date, was a day it wasn't participating in the market's long-term upward trajectory. Those seemingly insignificant daily opportunities for growth compounded into a substantial performance gap over time. Of course, looking at average returns doesn't tell the complete story. Market returns are never as smooth as our simplified 8% annual growth model suggests. In reality, both Teresa and Connor would have experienced significant volatility. Years with double-digit gains, quarters with sharp declines, and perhaps even a full-blown bear market during their decade-long investment journey. Even accounting for this real-world volatility, the mathematics of time and compounding heavily favored Teresa's approach in most market scenarios. The extra months and years her entire investment spent in the market created an advantage that Connor's strategy simply couldn't overcome under typical conditions. Teresa's approach statistically paid off with significantly higher returns, despite the initial anxiety she experienced. Her willingness to endure short-term emotional discomfort yielded substantial financial benefits that grew more meaningful with each passing year. The exception to the rule, when DCA actually wins. Statistical advantages don't always tell the complete story in real-world investing. While Teresa's approach won in most scenarios, there's a fascinating exception that makes financial advisors hesitate before completely dismissing dollar cost averaging. What happens when the market doesn't just dip but plummets right after you invest? Let's explore the scenario that keeps investors up at night, the dreaded market crash. Imagine if Teresa had invested her entire $10,000 just weeks before the 2008 financial crisis began. In this alternate timeline, she would have watched in horror as her investment quickly shed 30 to 40% of its value. Meanwhile, Connor's strategy of spreading his investments would have allowed him to purchase shares at progressively lower prices as the market fell. This isn't just a theoretical example. During significant market downturns like the 2008 financial crisis, dollar cost averaging has proven to be more than just psychological comfort. It can actually deliver superior returns. When markets enter bear territory, the mathematical advantage shifts dramatically in favor of Connor's approach. Here's why this happens. When Teresa invests her lump sum at a market peak, she buys all her shares at the highest price. But when Connor continues making his regular investments as prices fall, he automatically buys more shares when they're cheaper. This effectively lowers his average cost per share, a concept investors call averaging down. A case study examining investment strategies during the 2008 crisis revealed something remarkable. An investor who used dollar cost averaging over 10 months ended up with a significantly higher portfolio value than someone who made a lump sum investment right before the market tumbled. The DCA investor was able to accumulate substantially more shares during the market's lowest points, which then appreciated dramatically when the recovery began. The same pattern emerged during the early 2020 COVID market crash. Those who gradually deployed their capital as markets plunged in March and April were able to capture extraordinary value, buying quality companies at fire sale prices. Their average purchase price was much lower than investors who went all in before the pandemic hit. This isn't just about minimizing losses, it's about maximizing opportunity during downturns. When markets decline sharply, each dollar invested buys more ownership in the underlying companies. It's like finding everything in your favorite store suddenly marked down 30 to 50% off. Your money simply goes further. The effectiveness of dollar cost averaging becomes particularly pronounced in these volatile market environments. For example, someone who invested $833 monthly throughout 2008-2009 would have automatically bought twice as many shares when the market hit bottom compared to their first investment. When those shares eventually recovered, the gains were magnified. But here's the critical question that changes everything. Can you predict when these market crashes will happen? This is where the practical advantage of dollar-cost averaging breaks down. Research consistently shows that even professional investors struggle to time market downturns accurately. For every investor who correctly sidesteps a crash, countless others miss out on substantial gains by staying on the sidelines too long. The uncomfortable truth is that market timing is nearly impossible to get right consistently. Missing just a handful of the market's best days can dramatically reduce your overall returns. Many investors who pulled their money out during market crashes miss the powerful rebounds that typically follow. Think about it this way. For dollar-cost averaging to outperform lump sum investing, you need to know in advance that you're about to experience a sustained market decline. Without this crystal ball, you're effectively betting against the market's long-term upward trajectory, a bet that history shows is wrong more often than it's right. Even during the brief periods when DCA outperforms, the advantage is temporary. Once markets recover, which they historically always have, the mathematical advantage typically swings back to lump sum investing. The 25 to 35% of times when dollar-cost averaging wins are concentrated almost exclusively in periods immediately preceding significant market corrections. Let's revisit Teresa and Connor's situation with a twist. Imagine they both received their $10,000 in September 2008, just before the worst of the financial crisis. Teresa immediately invested her full amount when the S&P 500 was around 1,200. Connor began his monthly investments of $833, continuing through the market bottom when the index fell below 700 in March 2009. By the time Connor made his final installment in August 2009, the market had already begun recovering. His average purchase price would have been significantly lower than Teresa's, resulting in more shares acquired. When the market eventually returned to pre-crash levels in 2013, Connor would have had a noticeably larger portfolio. But here's the crucial point. Neither Teresa nor Connor could have known in September 2008 that one of the worst market crashes in history was about to unfold. Their decision between lump sum investing and dollar-cost averaging would have been made without this critical information. The psychological aspect of investing plays a crucial role here. Many investors choose dollar-cost averaging during uncertain times to avoid the potential regret of investing right before a market peak. This emotional comfort can be compelling despite the strategy's lower expected returns in most market environments. Some experts suggest that the real value of dollar-cost averaging isn't in its mathematical optimality, but in its ability to keep investors in the market during turbulent times. The strategy removes the pressure of timing decisions and creates a systematic approach that runs on autopilot, reducing the likelihood of making emotional mistakes during market volatility. In essence, dollar-cost averaging works as a hedge against terrible timing. It's insurance against the worst-case scenario, investing everything just before a market collapse. Like most insurance, you pay a premium in the form of potentially lower returns for protection against a specific risk. The challenge is that we pay this premium during all market conditions, even though the protection only proves valuable during relatively rare market crashes. It's like continuing to pay for flood insurance during a decade-long drought. The risk mitigation strategy, balancing math and emotions. That flood insurance analogy raises an important question. What if you could tailor your investment approach to match your personal risk tolerance? Most financial experts present lump sum investing and dollar-cost averaging as an either-or choice, but there's actually a middle path that few advisors ever mention. Let me introduce you to what investment researchers call the risk-matched approach. This hybrid strategy gives you the best of both worlds by investing a significant portion of your windfall up front, typically around 60%, while gradually deploying the remaining 40% over time. This method isn't just theoretical. It's backed by solid research showing it captures most of the mathematical advantage of lump sum investing while significantly reducing the psychological pressure that comes with market volatility. Think about our characters, Teresa and Connor, for a moment. Teresa went all in with her $10,000, which statistically gave her the best chance for maximum returns, but also exposed her to maximum short-term anxiety. Connor played it safe with complete dollar-cost averaging, giving up potential gains for peace of mind. But what if there was a third character in our story? Meet Alex, who took the hybrid approach. After receiving the same $10,000 windfall, Alex immediately invested $6,000 in a diversified portfolio and set up a plan to invest the remaining $4,000 in equal installments over the next 6 months. This approach gave Alex substantial market exposure from day one, while keeping some powder dry to average into any potential downturns. The psychological benefits of this approach are significant. By having a chunk of money already working in the market, Alex avoided the nagging feeling that comes with keeping everything on the sidelines, that sense that you're missing out on potential growth. At the same time, having some money still waiting to be invested created a psychological safety net. If the market dropped shortly after that initial investment, Alex could take comfort in knowing not everything was exposed to that decline. What's fascinating about this approach is how it affects our emotional relationship with investing. The initial lump sum portion satisfies our logical brain that knows markets tend to rise over time, while the gradual portion soothes our emotional brain that fears loss and regret. It's like having both an aggressive growth investment and an emotional insurance policy rolled into one strategy. This approach is particularly valuable when you consider what happens to most investors during market volatility. Many people who start with good intentions end up abandoning their investment plans entirely when emotions run high. The hybrid approach makes it easier to stay the course because you've already acknowledged and accommodated your emotional needs in the initial strategy. Let's look at some numbers to see how this might have played out for Alex compared to Teresa and Connor. In most scenarios, Alex's returns would fall somewhere between Teresa's and Connor's, capturing perhaps 80 to 90% of the lump sum advantage while experiencing only about half the emotional turbulence. The small premium Alex pays for this psychological comfort is often worth it because it dramatically increases the likelihood of sticking with the investment plan long term. What makes this approach so powerful is its flexibility. You don't have to use a strict 60-40 split. You can adjust based on your personal risk tolerance. Someone with higher risk tolerance might go 80-20, while someone more conservative might prefer 40-60. The key is finding your personal balance point where mathematical optimization meets emotional sustainability. This hybrid approach also has another significant advantage. It forces you to create a concrete investment plan before receiving a windfall. Having a predetermined strategy helps prevent the emotional decision-making that often happens when a large sum suddenly appears in your bank account. Without a plan, that money can sit in cash for months or even years while you deliberate, missing out on potential growth the entire time. The emotional barriers to investing aren't trivial. Studies show that the stress associated with making major financial decisions can significantly impact how we allocate our resources. When faced with market uncertainty, our brains often default to what feels safe rather than what the data suggests is optimal. By acknowledging these psychological factors up front and building them into our strategy, we're more likely to make choices that serve our long-term financial interests. Consider this. Many investors who intellectually understand the advantage of lump sum investing still can't bring themselves to pull the trigger. They keep waiting for the right time that never seems to arrive. The hybrid approach gives these investors permission to move forward without requiring them to overcome all their psychological barriers at once. One particularly effective way to implement this strategy is to pair it with automatic investments. After making your initial larger investment, set up the remaining installments to happen automatically. This removes the ongoing decision fatigue that comes with having to repeatedly convince yourself to invest more money. Each scheduled investment happens without requiring another emotional hurdle to be cleared. The risk-matched approach also shines during extreme market conditions. If you're lucky enough to make your initial investment right before a bull market, you'll have a substantial portion of your money capturing those gains immediately. If you're unlucky and invest before a significant downturn, your remaining installments will allow you to buy at lower prices, softening the psychological blow of that initial decline. This approach isn't just about splitting the difference between two strategies. It's about creating a third option that's potentially more sustainable for real humans with real emotions. Financial strategies only work if you can stick with them through market turbulence. The mathematically optimal approach that you abandon during a market correction will ultimately perform worse than a slightly less optimal approach that you maintain throughout. Finding your personal balance between mathematical optimization and emotional comfort isn't just a nice idea. It's the key to long-term investment success. The investors who build the most wealth over time aren't necessarily those who know the most advanced strategies or have access to the best investments. They're the ones who develop sustainable approaches that they can maintain through bull and bear markets alike. The decision framework. What to do with your next $1,000 plus. When that unexpected $1,000 lands in your account, whether from a tax refund, bonus, or family gift, most people freeze. That moment of decision can feel overwhelming, but I'm about to show you a practical framework that transforms this financial crossroads into a clear path forward. Instead of getting stuck in analysis paralysis, you'll have a personalized roadmap that addresses both the math and the emotional reality of investing. Let's build your decision tree for that next financial windfall. First, ask yourself, what's my current financial situation? Before investing any lump sum, ensure you have an emergency fund covering 3 to 6 months of expenses. If you're carrying high-interest debt like credit cards charging 15 to 25%, prioritize paying those off first. That's an immediate guaranteed return matching your interest rate. Once those basics are covered, it's time to assess the amount you're investing. The size of your windfall matters more than you might think. For smaller amounts, say under $1,000, the difference between lump sum and dollar cost averaging becomes less significant in absolute dollar terms. You might just invest it all at once to avoid the hassle of multiple transactions. For larger amounts like $10,000 or more, the potential opportunity cost of choosing the wrong approach grows substantially, making your strategy more crucial. Next, honestly evaluate your risk tolerance. This isn't just about how you feel during good markets, it's about how you'll react when your investment drops 20% in a month. Would you panic and sell? Or would you stay the course? If market volatility keeps you up at night, a hybrid approach might be worth the potential opportunity cost. Remember that an investment strategy you abandon during market turbulence is ultimately worthless, no matter how mathematically optimal it might be. Your investment time horizon is another critical factor. If you're investing for a short-term goal, less than 5 years, market volatility becomes a much bigger concern, making a more conservative approach reasonable. But for long-term goals like retirement that are 10, 20, or 30 years away, temporary market fluctuations matter much less. The longer your time horizon, the stronger the case for getting your money working immediately through lump sum investing. Here's a practical approach. Create decision rules before the money arrives. Setting predetermined guidelines helps overcome the emotional barriers that prevent decisive action. For example, you might decide, when I receive my annual bonus, I'll immediately invest 70% into my predetermined asset allocation and spread the remaining 30% over the next 3 months. This approach combines the mathematical advantage of having most of your money working right away with the psychological comfort of not putting everything in at once. By establishing these rules in advance, you remove the decision fatigue that often leads to procrastination and missed opportunities. Consider your market outlook as well, not as a timing mechanism, but as a reality check. If markets have been extraordinarily volatile or just experienced a massive run-up, you might lean more toward a gradual approach. Conversely, after a significant market correction, the case for lump sum investing becomes even stronger as valuations are more attractive. Let's make this concrete with specific scenarios. For a tax refund of $2,500, once your financial foundation is solid, investing the full amount immediately in a low-cost index fund aligns with both optimal returns and simplicity. The one-time nature of the transaction eliminates decision fatigue, and the modest sum means the absolute dollar difference between strategies isn't enormous. For a $20,000 inheritance, the stakes are higher. The potential opportunity cost of delaying investment grows significantly with larger sums. This might be a perfect case for the hybrid approach, perhaps investing $12,000, 60% immediately into your chosen asset allocation, then setting up automatic investments of $1,333 monthly for the next 6 months. This balances the statistical advantage of prompt investing while providing emotional comfort if markets decline shortly after. For a $50,000 plus windfall from selling a property or business, consider layer stacking your investments. Start with an immediate 50-60% investment, then create a schedule with decreasing time intervals. Perhaps 15% after 1 month, 10% after 2 months, 10% after 3 months, and the final 10 to 15% after 4 months. This approach front-loads your investment to capture returns while still providing the psychological benefit of averaging. It's helpful to calculate the actual potential cost of choosing dollar cost averaging in concrete terms. Based on historical market returns of around 10% annually, every $10,000 that sits uninvested for a year potentially misses approximately $1,000 in growth. For a 6-month dollar cost averaging plan, you'd have an average of half your money uninvested during that period, potentially costing you around $500 per $10,000 in opportunity cost. This isn't to say you should always choose lump sum investing, regardless of circumstances. Rather, it helps you make an informed decision about whether the emotional comfort of dollar cost averaging is worth the potential opportunity cost in your specific situation. There are also practical strategies to overcome the psychological barriers to lump sum investing. One effective approach is to practice with smaller amounts. If you're hesitant about investing a $50,000 windfall all at once, start by immediately investing $5,000 or $10,000. This gives you a taste of the emotional experience while still moving toward action. Another powerful technique is to reframe how you think about market declines. Instead of seeing them as losses, view them as opportunities. What if markets drop 15% shortly after your lump sum investment? Instead of regretting your decision, consider adding more money at these lower prices if possible. This mindset shift turns what feels like a negative into a potential positive. Setting decision rules in advance can be particularly helpful for overcoming the emotional barriers associated with lump sum investing. By determining a specific percentage of the lump sum to invest immediately and scheduling the remainder for gradual investment, you create a structured plan that balances mathematical optimization with emotional comfort. This approach helps you avoid impulsive decisions driven by market fluctuations, while still getting a significant portion of your capital working immediately. Remember that your investment plan should align with your broader financial objectives. Are you investing for retirement, a child's education, a home purchase? Each goal might have different time horizons and risk considerations that influence your approach. The key is to develop a structured investment plan that reflects your personal financial situation and objectives. Social accountability can also help overcome investment procrastination. Share your investment plan with a trusted friend, financial advisor, or spouse. Committing your intentions to someone else dramatically increases the likelihood you'll follow through, even when emotions try to derail you. Most importantly, don't let the pursuit of the perfect strategy prevent you from taking good action. The opportunity cost of holding cash while waiting for the ideal moment to invest can be substantial, as historical data consistently shows that cash investments typically underperform compared to equities and bonds over time. Even an imperfect investment strategy that gets your money working for you is generally better than perfect analysis that leads to indefinite postponement. The time value decision. Opportunities beyond investing. The psychological barriers we've been exploring don't just sabotage your investment decisions, they're silently draining your wealth across your entire financial life. While we've focused on Teresa and Connor's investment strategies, the same mental traps that lead to procrastination with investing are costing you in virtually every money decision you face. Think about the last time you put off a financial decision. Maybe it was delaying setting up that retirement account, postponing paying extra on your mortgage, or waiting for the right time to start a college fund for your kids. That hesitation isn't just a delay, it carries a very real price tag. The concept of emotional opportunity cost explains why this happens. This is the potential loss you incur by delaying financial decisions because of emotional factors like fear of making a mistake or anxiety about the future. Just like waiting to invest can cost you thousands in potential returns, emotional barriers to other financial decisions can significantly impact your long-term wealth. Let's look at retirement savings. Many Americans delay starting their 401k contributions, often waiting years after they're first eligible. This procrastination is devastating to long-term wealth building. The math is brutal. Waiting just 5 years to start retirement contributions can reduce your final nest egg by over 30%. That's not just a small mistake. It's potentially hundreds of thousands of dollars lost by retirement age. The same principle applies to debt repayment. When you have extra cash and debate whether to pay down debt or wait, that hesitation has a measurable cost. For high-interest debt like credit cards, every month of delay compounds against you. If you have a $5,000 credit card balance at 18% interest, waiting just 6 months to start aggressive repayment can cost you hundreds in additional interest, money that could have been growing in your investment accounts instead. Loss aversion, feeling losses more painfully than equivalent gains, plays a major role here too. When paying down debt, we often don't feel the immediate satisfaction of gaining something, which can make us hesitate. But mathematically, paying off an 18% interest debt is equivalent to earning an 18% guaranteed return on an investment, a rate nearly impossible to match in the market. Home buying decisions suffer from similar psychological barriers. Many prospective homeowners wait endlessly for the perfect time to enter the market, when prices drop, when interest rates hit rock bottom, or when they've saved the ideal down payment. This waiting game often costs more than pulling the trigger on a good, but not perfect opportunity. While timing does matter in real estate, the cost of waiting can quickly outpace the benefits of perfect timing, especially considering the wealth-building aspects of property ownership and mortgage principal reduction. Business owners and entrepreneurs face this challenge on an even larger scale. The fear of failure can be so paralyzing that many never launch their businesses, despite solid plans and promising market conditions. Research shows this fear of failure becomes the worst financial decision of all: doing nothing. A business started with a good, not perfect plan today typically outperforms the theoretical perfect business that never launches. What about education funding? Parents often delay starting college savings accounts for their children because the goal seems so far away. But starting a 529 plan when your child is born versus waiting until they're 10 creates a massive difference in the final educational fund. Potentially the difference between covering full tuition versus taking on substantial student debt. These psychological barriers, fear, uncertainty, and the illusion of perfect timing, create a pattern of postponed financial decisions that compound over time. The real tragedy is that most people never calculate this invisible cost of delay, focusing instead on the immediate emotional comfort of avoiding difficult choices. Automation can help overcome these barriers. Setting up automatic contributions to retirement accounts, extra mortgage payments, or debt repayment plans removes the emotional decision-making process entirely. The research is clear. Systems that run without requiring continuous decisions dramatically improve financial outcomes. Let's consider a real example. 2 friends graduating college with identical student loan debt of $30,000. Friend A sets up an aggressive automatic payment plan and adds an extra $200 monthly toward principal reduction. Friend B makes minimum payments while waiting for extra money to make lump sum payments, which rarely happens due to lifestyle spending. After 10 years, Friend A is debt-free and building wealth, while Friend B still has years of payments ahead and has paid thousands more in interest. the effects of these delayed decisions compound dramatically over a lifetime. Someone who consistently makes timely, even if imperfect, financial decisions across all areas, investments, debt repayment, housing, insurance, and retirement planning, will end up with substantially more wealth than someone who consistently delays decisions waiting for ideal conditions. This pattern exists because our brains aren't naturally wired for optimal financial decision-making. We're programmed to avoid immediate pain, making sacrifices today for abstract future benefits. We struggle to visualize our future selves and tend to discount the value of future rewards. The emotional stress associated with financial decisions can lead to what psychologists call decision paralysis. When faced with complex choices with uncertain outcomes, many people default to taking no action at all. This explains why only 44% of American workers feel confident about their retirement savings when working without an advisor. The complexity creates emotional barriers that lead to procrastination. Breaking this cycle requires recognizing that delaying financial decisions is itself a decision, and usually the wrong one. Just as lump sum investing typically outperforms dollar cost averaging, taking decisive action on your broader financial life typically outperforms waiting for perfect conditions. Start by identifying one financial decision you've been postponing. Whether it's increasing retirement contributions, refinancing high-interest debt, or finally setting up that will or estate plan, calculate the actual cost of waiting another 6 months. For most decisions, this quantifiable cost will surprise you and provide the motivation needed to take action. Remember that emotional barriers to financial decisions often disguise themselves as rational considerations. I'm waiting for the market to stabilize. I'll start saving more when I get my next raise, or I'll get serious about my finances once I'm making more money, are all ways our brains justify delaying decisions that should be made today. Financial advisors often see this pattern with estate planning. Many clients postpone creating wills or trusts, citing perfectly logical reasons like, I need to think more about guardianship for my children, or I want to research more tax strategies. But these seemingly rational considerations frequently mask emotional discomfort with addressing mortality. Meanwhile, the protection and financial security these documents provide remain unestablished. The generational wealth gap, young investors' advantage. Financial delay costs everyone, but it absolutely devastates younger generations in ways they don't even realize. Despite facing unique economic challenges like skyrocketing housing costs and student debt, today's 20 and 30-somethings possess a superpower that older investors would pay millions to get back: time. But here's the shocking truth about what happens when you waste this advantage. Generation Z is showing some incredible financial habits that previous generations would envy. About 35% already have business plans or have started a business, and they're notably cautious about debt, with only 21% wanting to take student loans. This financial awareness is impressive, but there's a paradox at play. While they're more financially literate than their predecessors, with 64% actively researching financial planning, many still delay their most important financial decision, investing early. Why is this happening? The same psychological barriers we've discussed affect everyone, but they're particularly damaging for younger investors because they waste the most precious financial resource: time. Let me put this in perspective. Imagine two friends, both 25 years old. One starts investing $300 monthly today, while the other waits until they're 30 to start the exact same investment plan. Assuming an average annual return of 8%, by retirement at 65, that 5-year head start translates into over $150,000 in additional wealth. That's not a typo. 5 years of delay costs $150,000 in future money. The math gets even more dramatic when we consider lump sum investing. If you receive a $10,000 gift or bonus at 25 and invest it immediately versus waiting until 30, the difference at retirement isn't just the 5 years of growth, it's the compounding on that growth for the next 35 years. This is why financial decisions that seem small today can create massive wealth gaps later in life. What's fascinating is that young people are actually well positioned to embrace lump sum investing. According to research, younger investors can better tolerate short-term volatility precisely because they have longer time horizons. If you're 25, a market crash isn't a retirement-delaying catastrophe. It's a potential buying opportunity with decades to recover and grow. But here's where economics and psychology collide. Many millennials and Gen Z investors witnessed their parents struggle through the 2008 financial crisis or experienced the COVID market crash early in their investment journey. These formative experiences create lasting financial trauma that makes immediate investing feel risky, even when the math clearly supports it. This hesitation is particularly problematic because younger generations are gradually building financial independence. A Pew Research study found that 45% of young adults between 18 to 34 are completely financially independent from their parents, with this figure rising to 67% among those in their early 30s. As financial autonomy increases, so does responsibility for long-term financial planning. But without proper guidance, many miss their optimal investment window. The financial technology revolution is helping bridge this gap. Younger generations are increasingly embracing fintech solutions for budgeting and investing, which enhances their ability to make informed choices. These platforms can reduce psychological barriers by automating investments and providing clear visualizations of long-term growth potential. But technology alone can't solve the fundamental issue, the emotional hurdle of putting larger sums to work in the market. This leads us to a particularly valuable insight from Vanguard's research. Lump sum investing generally yields higher returns than dollar-cost averaging, especially in rising markets. For younger investors with decades ahead of them, this finding is pure gold. The statistical advantage of lump sum investing becomes even more powerful when combined with a long time horizon. It's like having two turbochargers on your wealth-building engine. Let's look at a concrete example that brings this to life. Imagine twins Alex and Jamie both receive $15,000 on their 25th birthday. Alex, understanding the power of lump sum investing, puts the entire amount into a diversified portfolio immediately. Jamie, feeling anxious about market timing, sets up a monthly investment plan, spreading the $15,000 over 2 years. By 35, assuming average market returns, Alex's investment might have grown to around $32,500, while Jamie's could be closer to $29,000. A $3,500 difference doesn't seem life-changing, but fast forward to retirement at 65, and Alex's account could be worth about $326,000 compared to Jamie's $291,000. That's a $35,000 difference, more than double their original investment, created simply by getting money into the market sooner. Financial experts have a term for this phenomenon: emotional opportunity cost. It's the substantial long-term financial loss that occurs when fear prevents prompt investment action. For younger investors, this cost is particularly high because they sacrifice decades of potential compound growth. What makes this concept so important for younger generations is the changing economic landscape they face. Housing costs have outpaced income growth, making homeownership more challenging. Student debt burdens delay wealth accumulation. Traditional pensions have largely disappeared. These factors make personal investment success not just important, but essential for financial security. Yet despite these challenges, the data shows that younger investors possess a unique advantage that actually makes investment success more likely: resilience through time. A 25-year-old investor today will likely experience 8 to 12 market corrections and potentially 2 to 3 major bear markets during their investment lifetime. This seems frightening until you realize that every historical market downturn has eventually recovered and reached new highs. The emotional impact of market volatility diminishes when your investment horizons stretches decades rather than years. That 15% market drop that keeps your uncle awake at night represents a minor detour in a 40-year investment journey. This psychological advantage compounds when combined with the statistical benefit of lump sum investing, creating a wealth-building opportunity unique to younger investors. Unfortunately, this opportunity comes with an expiration date. The power of compound growth diminishes dramatically with each passing year. Experts suggest that the psychological barriers faced by younger investors, including loss aversion and fear of market timing, can lead to procrastination that ultimately hinders their financial growth. Every year of delay cuts into decades of potential compound returns. The data is clear. While all investors should understand the advantages of lump sum investing over dollar cost averaging, this knowledge is absolutely critical for those in their 20s and 30s. The mathematical advantage of immediate investment, combined with the psychological resilience that comes from a long time horizon, creates a wealth-building opportunity that simply doesn't exist for older investors. So if you're under 35 and watching this video, understand that you possess a financial superpower that even billionaires can't buy: time. When you combine time with the statistical advantage of lump sum investing, you create a wealth-building formula that can transform modest investments into substantial retirement funds. Don't let psychological barriers rob you of this unique advantage. Now, if there's one message I hope you take away from today's video, it's this: the market rewards investors who show up early and stay committed. Research consistently shows that missing just a few of the market's best-performing days can dramatically slash your long-term returns. Those random best days are impossible to predict, which is why trying to time the market often backfires. Let's be honest about the psychological barriers we all face. Fear of loss and regret aversion can paralyze us into making decisions that feel safe, but actually cost us thousands in potential growth. This isn't just about numbers, it's about recognizing your own investment psychology and finding a strategy that lets you sleep at night while still capturing most of the market's upside. Take a moment to reflect on your own investment approach. Are you letting anxiety stop you from deploying capital that could be growing? Remember, the perfect time to invest never announces itself with a notification. The best time is almost always now, with a strategy you can actually stick with through the inevitable